Welcome, everyone. Thanks for joining us today. My name is Josh Campbell. I'm the CEO of Worth and Clara Media. We're really excited to partner with Atlas Merchant Capital on this series of economic updates. We've been publishing some of the key insights from their updates over the past 2 years. So really happy to bring this chat onto the Worth platform. At this point, I'd like to introduce Larry Cantor, who's the operating partner at Atlas, to provide some of his current thinking about the economy, and then we'll have some time for Q&A. So thanks everyone for joining us, and Larry, thanks for joining.
Thanks, Josh, and also I'd like to thank everyone for dialing in. I hope I can make this worth your time. What a difference a few months make. Things have really changed quickly as far as the economy and financial markets are concerned. Commodity prices have soared, particularly for food and energy. The Fed has shifted from being extraordinarily accommodative and well behind the curve to aggressive policy tightening, even as financial markets have cratered and the economy is showing clear signs of weakening. As a result of this, views on the economy have made a U-turn, going from sanguine to increasing concerns that we're heading into a recession. As for us, we've long been of the view that one, inflation wasn't going away anytime soon. Two, the Fed was going to have to hike rates a lot more than what markets were pricing in. And three, that this cycle wasn't going to end well. You can check the last few Worth Magazine articles we wrote if you want to confirm that. What has surprised us is the timing. All of this is being recognized sooner than we'd expected. From our point of view, the question now is not whether we're going into recession, but rather when and how severe. What's clear is that an inflection point occurred, probably in March or early April. After 2 years of excess in both financial markets and the economy, and you could say in policy, reflected in things like Bitcoin, ARK, goods consumption, we're now in the correction phase of this business cycle. Typically, the economy's in recession before anyone realizes it. And my guess is we're probably in the early stages of a recession, at least a mild one right now. A few months ago, a near-term recession seemed unlikely. Both business and household balance sheets were healthy, and they still are. Neither sector's over-leveraged. Meanwhile, the Fed was still maintaining overnight rates at zero and buying $120 billion worth of bonds every month, which was injecting huge amounts of liquidity into financial markets. Inflation has been accelerating for quite a while, over a year, reaching levels not seen in something like 40 years. But both the Fed and financial markets believed that monetary policy would not have to become restrictive to bring inflation down, back down to reasonable or acceptable levels. So a few things changed to completely undermine this rosy scenario. First, the supply chain situation, which, we've been talking about this since the pandemic started, and therefore inflation became a lot worse due to the war in Ukraine and the shutdowns in China. China is not only the world's largest exporter of goods, it's also home to 4 of the 5 largest shipping ports in the world. So when China shut down huge swaths of its economy as COVID reemerged, it put further upward pressure on prices. In the meantime, the war in Ukraine has produced massive shortages in both food and energy, causing their prices to surge. Russia is the 3rd largest energy producer in the world, while Russia and Ukraine together account for nearly 30% of global wheat exports, and Ukraine alone accounts for about 20% of corn exports. This situation is especially damaging to Europe. The EU, you probably know this, has been depending on Russia for about 45% of its natural gas and 25% of its crude oil. The US is much more insulated from these global events since it produces more oil and natural gas than any country in the world, and it's the third largest food producer. It's actually the largest per capita. Still, the surge in food and energy prices is hitting consumers and businesses pretty much everywhere. Second, the May CPI surprised on the upside and seemed to dispel hopes that inflation was stabilizing, which a lot of analysts still held on to. Headline inflation came at 8.6% year on year, which was a new high. Core inflation, which excludes food and energy, and is what the Fed targets, rose 0.6% on the month for the second month in a row, following smaller increases in February and March that had generated some optimism, quite a bit of optimism, actually, that it was stabilizing on its own. Finally, the Fed got religion when it comes to inflation. It hiked rates from 0 to a mere quarter point in March, but then did 50 basis points in May and shocked markets after a seeming leak into the Wall Street Journal and New York Times by 75 basis points last week. That's the biggest rate hike since 1994. Markets reacted to all of this by pricing in a much more aggressive Fed than it had expected previously. So right now, if you look at Fed funds futures, they're showing a 3.5% Fed funds rate by year end. We're sort of at 1.5 to 1.75 now. So that implies an additional 200 basis points or so of rate hikes over the remaining 4 FOMC meetings this year, sort of 50 basis points a meeting, or take any combination you want. So with the huge hit to consumer pocketbooks coming from much higher inflation, along with the expectation that the Fed is going to push policy rates up to a level that is restrictive, it's no surprise that both stock and bond prices have tanked. The effects of these negative shocks to the economy are already becoming apparent, even with the usual data lags. Manufacturing output fell in May, although that's not really surprising to see factory production decline as consumers shift spending habits away from goods and back toward service activities like travel, entertainment, going to restaurants, bars, gyms, spas, and so forth. That can also explain the disappointing retail sales figures, which dropped 0.3% in May, despite a 4% jump in gasoline sales, mainly because of prices. It's worth noting here that many retailers, including Amazon, overexpanded in response to the surge in goods demand generated by the pandemic. Their inventories are now excessive, signaling that an inventory correction is at hand. It's also not surprising to see clear signs of weakness in housing and autos. People are shying away from buying cars with prices 20% above where they were a year ago, gasoline at $5 a gallon, and financing rates rising sharply. Demand for housing is also declining as affordability has taken a huge hit due to the surge in home prices and mortgage rates, which have about doubled. Reflecting all this, unit auto sales fell 12% in May, and existing home sales dropped 3.5%, taking them back down to a level last seen in June 2020, when home buyers were still being spooked by COVID. But while a weakening in demand in these sectors is to be expected, output should be able to resist extreme declines because of large order backlogs. I mean, there was huge excess demand for housing and autos, as you all know. And in fact, car production has been rising since last fall as key components have become more available. But output still remains well below pre-pandemic levels, and there are still shortages in many models, suggesting that auto production should hold up for a while. That's not so clear in the housing sector, though. Housing starts fell a shocking 14.5% in May, putting them below where they were a year ago. While it's only 1 month, and the decline in new home construction is probably due at least in part to labor shortages, it's likely that home builders see what's coming and are acting well in advance to avoid an undesired buildup in inventory. If that's the case, the housing sector is probably in recession already. I should note, as an aside here, that if you take housing, autos, and inventories, that's basically what recessions are made of, and they're all getting hit as we speak. We are in a period of cross currents, though. The goods sector is clearly going down, while some service sector areas are still in recovery mode. So, where can you look here to judge what everything's doing? And it's really labor markets, because they provide timely data on all sectors. And so it's worth focusing on them to kind of gauge the state of the total economy. Overall, they're showing signs of weakening, but from relatively strong levels. So the unemployment rate has held steady. It was still 3.6% in May. Payrolls came in a very solid 390,000, although that's below the monthly average for this year of 488,000. But more notable is the more timely jobless claims numbers. They come in weekly, and they have been rising. So I like to look, they bounce around week to week, but the 4-week moving average is up nearly 50,000 from the low we saw on April 2nd. Usually, when you see a move of 50,000 or more, we're not quite there yet, I think it's 48,000, that usually heralds recession. Meanwhile, if you look at the number of unfilled jobs and you look at the Conference Board survey of jobs hard to get, both seem to have passed inflection points, even though they both show strength. The bottom line is that the economy's been hit really hard by the surge in inflation, tightening financial conditions, and prospects for aggressive monetary tightening. Europe seems to be in recession already, and the US, at a minimum, has entered a period of much slower growth. Given the combination of these hits, as well as the expiration of most of the fiscal stimulus that was applied during the pandemic, it's hard to believe that we're not in recession, or at least heading into one. But the good news, it's likely to be moderated by a number of positives. First is that consumers built up their stock of savings during the pandemic, enabling them to dig into that even as inflation diminishes the purchasing power of their income. While household wealth has declined since the start of the year, it remains at historically high levels. It's now over $30 trillion higher, this stock prices and house prices mostly, than before the pandemic. Meanwhile, consumers are not crippled by unusually large debt burdens, looking at coverage ratios like interest payments to income. Meanwhile, on the business side, profits have remained strong. Many companies were able to lock in low long-term financing rates. That said, profit margins do seem to have peaked. A number of service industries, as I just said, are still in recovery mode. And not only that, and this is important, given how historically tight the labor market's been, with a record level of unfilled jobs, weaker labor demand should show up initially in fewer unfilled openings rather than layoffs. As we mentioned earlier, production in supply-constrained sectors like autos should be able to withstand a degree of weakening in demand without reducing output dramatically, at least at first. While all of this suggests that the recession is likely to be mild, I would not rule out a more severe recession, especially if the Fed's not patient in getting inflation down and continues on a highly restrictive course, even as the economy continues to weaken. I have to say it's unusual to see the Fed in such a act in such a pro-cyclical manner. Usually, it begins to hike rates while the economy is still growing strongly and financial asset prices are going up, basically adhering to the mantra first described by, when I say former Fed chair McChesney Martin, we're talking about a long time ago. He said the Fed's job, you probably heard this, is to take away the punch bowl just as the party is warming up. But this time around, the Fed waited to begin tightening until the economy and financial markets were already peaking. Pursuing a pro-cyclical monetary policy is dangerous. Hopefully, there are enough offsets to avoid a severe recession. I think probably the most important thing will be a recognition by the Fed that it's going to take time to bring such a high rate of inflation down to an acceptable level. And not only that, it's probably, the Fed's probably going to have to accept a higher rate of inflation than its target of 2% for quite a while. Excuse me. Inflation, as high as it is now, has never been easy to bring down. It's been accelerating for over a year, well before the Fed began to remove its extraordinary accommodation. And that allowed it to gain a momentum that makes it hard to reverse. Producers have seen the prices they pay for goods inputs rise even faster than the consumer price index. And the historically tight labor market is putting upward pressure on labor costs. Complicating matters further, some of the structural factors that kept inflation low and stable for decades have been or are in the process of unwinding. And two come to mind. One is cost will no longer be driving production location to the extent it was before. These are longer term trends. The pandemic and the war in Ukraine have made companies more wary of depending on output in countries with unstable or autocratic governments. And many countries, including the US, are encouraging businesses to produce domestically. Also, the multi-decade trend toward free trade, talking about the removal of tariffs and trade barriers, the creation of free trade zones, has been trending in the opposite direction in recent years as countries increasingly enact more inward-focused trade policies. To sum this all up, globalization, which played a major role in delivering decades of low and stable inflation, seems to be unwinding. The return of high inflation presents a much more difficult environment for financial markets. When inflation was low and stable for all those years, it allowed the Fed to cut policy rates to zero and flood the financial markets with huge liquidity injections whenever an economic crisis showed up. Those days, I'm afraid, are over for the foreseeable future. So at this point, just moving to financial markets, they seem to be pricing in recession risks appropriately. As you know, the S&P's already fallen by more than 20%. Futures were down today. Wouldn't be surprised if we're close to 25% by the end of the week. That said, I'd expect to see it fall somewhat further as weaker economic news accumulates and the Fed keeps hiking rates aggressively. And you may have seen these things, but if you look historically, the average S&P drop in post-World War II bear markets is about a third, although there's a wide range. Meanwhile, most valuation metrics have gone from expensive to barely below historic averages. And I'd expect them to become still cheaper once a recession becomes fully realized. Going to bond yields, they also would seem to have more to run. I mean, the 10-year Treasury yield's already breached the roughly 3% ceiling that prevailed for about a decade before the pandemic. But the inflation rate remains well above where bond yields are, and short-term rates continue to rise as the Fed allows its balance sheet of bonds to run off. I'd expect a further sell-off in bonds as well. So let me stop there to leave some room for questions. I appreciate your time. I do think we have some time for questions, right, Josh?
That's great. Thanks, Larry. Definitely a challenging time. I do want to go back to a couple of things you said about, let's see, household balance sheets were healthy. We were accumulating. Consumers were accumulating assets over this time. Where do you see this market? Volatility, inflation. What will be the impact on household savings? How will households have to adapt?
Right. So first of all, we should. It's a good question. I can't give you a precise number, but I'll say this. First, you have to distinguish wealth from savings. So wealth is net assets. And I mean, they went down a little bit by about $500 billion. That might not sound so much, but not so little in the first quarter. But they rose almost 32 trillion during the 2 years of the pandemic, which, this is house and stock price, which is enormous. So they could take a hit. Spending though, comes from income and savings, not really. It's less from wealth. And there's two sides to this, because the extra saving came from basically two sources. At the upper end, it was because, so the wealthier people, high income people, were just doing a lot less servicing. They weren't going on vacations. They weren't going out to expensive restaurants. They weren't attending sporting events and Broadway shows and so forth. So their savings piled up. Now they have a lower marginal propensity to consume because they earn a lot more. So, and not only that, but I'm sure they put a lot of that extra saving in financial assets, which are taking a hit. But then the rest of it came from actually the lower end, the people who were receiving stimulus checks, extra unemployment benefits, child tax credits, and the like. And I don't think those people, I think those people were paying off debt. And I think I would assume, kept it in very liquid assets like bank accounts. And there's still, I just looked this morning at savings, which is basically income minus spending. So versus net worth, which is a stock thing. So, and at one point they were over 5 trillion more than they had been in the fourth quarter of 2019 before the pandemic, which is stunning. That's like 25% of GDP. So what I think is happening here is that as we see this inflation, and as I pointed out, it's especially in food and energy, which really hits lower income people because everybody buys food and energy. I think they're still able to dig into the savings, but that's going down. And we've already seen that, actually. The saving rate's gone down, and the stock of savings, if you just look at the stock of savings, it's moved down quite a bit. There's still some left there, but we're talking probably about another few months before, you see a bigger reel back in spending.
Yeah, as long as the average household and consumer thinks that way, right? That they have actually had it good for a couple of years and they're just actually tapping into that.
Right.
I think it's interesting. And I think that sort of dovetails with the real estate, sort of question, and sort of this time that we've had. Many of us have seen, sort of our own home values, property values going up. Now, as you're saying, sort of, we'll see interest rates go up. I was reading something yesterday about, the resurgence of the adjustable rate mortgage, and how, obviously a factor in the housing crisis, way back when people couldn't make these sort of payments when they ballooned. What do you see for real estate, and how are these factors going to play into that as well?
Well, I mentioned May housing starts, so that's new construction. To see it this early fall 14.5% in 1 month and go back down below where it was a year ago is pretty shocking. Home builders definitely don't want to be stuck with inventory like they were in 2006. So what I think about, and by the way, I want to distinguish between commercial and residential because you said real estate. On the residential side, we're going to take a hit, but it's going to be nothing like 2006, 2007, 2008. And that's because of two things. One, home builders overbuilt back then. I mean, I have a house in Florida. It was amazing how many things were going up and were left empty for quite a long time. That did not happen this time. In fact, there were shortages. It was actually surprising that construction wasn't going stronger, given how demand for housing was so strong. I think part of that was labor problems.
Labor and supply chain, probably.
Yeah, I think a lot of people left the construction market after the financial crisis. The second positive is that consumers were way over leveraged. You remember all the home equity loans and all that stuff. That didn't happen this time. When you, at least in the aggregate, I'm sure there are some that are, but when you look at things like coverage ratios, a lot of people look at debt relative to income. To me, that never made any sense. Debt's a stock and income. What you want to look at relative to income is interest payments. And that these remain, they never got to crazy levels like they did in 2006. So in short, consumers really haven't been over leveraged and builders didn't overbuild. So there's a hit. Now on the commercial side, that's a different story. And I think the hit's going to be bigger there this time. I think for two reasons. One, shopping malls, we know what's happening there, spending going more and more electronic. and office buildings, businesses requiring less office space. Now, over time, if you take a place like New York City, some of that inevitably will be converted to residential, I think. But in the meantime, I'd say commercial takes a bigger hit than residential.
Interesting. So, obviously a big part of our Worth community is RAs, registered investment advisors. What is sort of the implications of all this on that, sort of group?
Yeah. So, I mean, I don't know about financial advisors and what happens here. If you talk about the financial services sector in general, it sort of depends where area you're in. I mean, banks right now, what I'm seeing in the big banks is that the investment banking side, deals and stuff have already taken a big hit from huge levels. I mean, the amount of M&A activity and SPACs and everything else was extraordinary, and that's fallen off. But trading's been fantastic, especially in fixed income. And so I think you're going to see this balancing where trading revenues way up and deals are down, the banking side. As far as advisors, I think it's going to be a very mixed story. I think for financial advisors that put people into, let's ride ARK, the tech trade, and really putting all their eggs in there, that's going to be pretty ugly. But for investment advisors who advise people, look, we have a balanced portfolio, and that people buy what they're saying, which is, that the stock market earns higher returns because it's more volatile. I mean, that's why it earns more than bonds or treasuries. So, it's funny, if you do a long-term chart of the S&P, like 50 years, you can Google it, the big stock market drops, 1987 and so forth, look like blips. So I think there'll be a bifurcation here where people who took big risks with their advisors are going to, I don't know if they'll yank their money out, but versus the ones that offered diversified portfolios and looking at the long term. So I think there's probably a mix there.
Right. Yeah, and I think taking sort of a tempered approach right now, right, not to be too reactive to the market.
Right.
Well, Larry, we appreciate you taking the time with us, today. We appreciate the partnership with Atlas and look forward to doing more of these in the future. For those of you joining us, we thanks again for making the time. The video will be available on the site within the next couple days. Hopefully you'll spread the word about we'll be doing these quarterly. We appreciate it, and thanks again for the time. And Larry, look forward to hearing from you again soon.
So do I. Repeat what Josh says. Thanks for tuning in.
Great. Thanks, everyone.